Hello, it's Mr. Intermarket Analysis. I'm going to be covering the EUR-USD weekend analysis. I'm trying to forecast or trying to see where this pair's headed, or where this pair's actually traded throughout the week as well, given the fact that it's a 2nd November 2013, and looking to forecast where this pair's headed in the week ahead from the 4th of November onwards. Okay. Right then, let's have a look. Okay, so let's go over the fundamentals first and try and give you a background as to what's happened during the week. Okay, so initially, obviously, we had the concept of taper on, taper off. The EUR-USD obviously had rallied quite significantly into the 138.50 level, which can be seen obviously in the weekly chart. Obviously, we've got a bearish engulfing candle, but let's just go to a daily chart. So obviously, given the fact that we've from the 25th of October onwards, obviously this market had gone to 138.30 based on the fact that the Federal Reserve was going to taper. The European Central Bank was anti-negative deposit rates, was not talking about any currency debauchery, any QE. Talk of interest rate cuts were off the table. They kept sidestepping the question. Draghi wasn't as bearish, or should we say as dovish, so we say, on the actual in terms of monetary policy. Now that was primarily due to German elections uncertainty. That's one of the reasons why. Then obviously throughout the week we had the concept of a tapering situation, or expectations of tapering doing a U-turn again. Okay, so you had expectations of no tapering in December off the table going into 2014, mid 2014. Everybody in the media talking about mid 2014 tapering, mid 2014, unlimited QE, and obviously the stock markets have rallied based on them expectations of easy money. The Kool-Aid is still there, so on and so forth. Okay, so that encouraged the trade in terms of the carry trade. Okay, that certainly encouraged the carry trade, and euro and yen. Obviously, yen pairs were doing quite substantially well. Even sterling was doing quite substantially well at one point as well. And obviously, all that's unwound now. Okay, so adding the CHF as well, so everything's unwound. Okay, so risk on, risk off. Obviously, last few days we've had a risk off scenario. Okay, so basically there were the backdrop. So obviously, the fact that tapering expectations changed, that helped the US dollar rally and gain support, so that pushed higher. And then all of a sudden you had the ECB do a U-turn with Mr. Nowotny's comments of talking about a negative interest rate, talking about QE now, given the fact that the German economic data, Bundesbank lowered its demand forecast by half, GDP growth forecast going forward, given the fact that there was deflation in Germany, which is a concern. Like I said before in my previous videos, the Eurozone is all about Germany, full stop. As soon as Germany starts to feel the pinch, then something's going to happen. Okay, if the periphery feels a pinch, they don't really care. Okay, so that's basically how it works, because Germany is the powerhouse of Europe. So adding the fact that the inflation data was weak, the IFO expectations were weak, so overall German data is weak. Nobody cares about the periphery. Okay, it is cannon fodder and collateral damage, I tend to call it. It's all about Germans. So as soon as the Germans start to suffer, then the pressure is exerted on the ECB. And Mr. Draghi is a puppet, and he will obviously adhere to whatever Miss Merkel has to say. Okay, so again, concerns there. Okay, adding the fact that you've had Miss Merkel's phone calls being listened to by the US, obviously that's caused some tension between Germany and the US, and obviously increased rhetoric there between the two, with the Snowden obviously being courted by the Germans and so on and so forth. Again, that's all a risk-off type scenario, because it creates geopolitical uncertainty, political uncertainty on this occasion, and that obviously helps the US dollar gain traction as well, given the fact that everybody was heavily short the dollar, given obviously on expectations of mid-2014 tapering, and now the Fed is open to tapering in December because they wanted to take out hot air out of the market, given the fact that global equities were moving higher. Obviously take all that into consideration, hence the reason why you've had a US dollar rally. Okay, and the adding a double whammy from the ECB talking about QE, and this is where we are. Okay, so that's the reason why we had a bearish engulfing candle on the weekly chart of the euro, and that was interesting, given the fact that technically anyway it was calling for a reversal. Okay, given the fact that the Eurozone exports are getting hurt, there was obviously whispers and talk of a potential rate cut, even though the ECB were denying it. Now all of a sudden they want to play the QE game as well, because that's the only way to revive the economies. They've tried austerity, that hasn't worked. Now they want to try pro-growth policies. Okay, especially given the fact that they all want to win elections at home, and that's probably the only way to do it. Okay, so and obviously Spain's picking up as well. Although the growth was anemic at 0.1% GDP, that's really the only way forward for Europe now to sustain itself and lift the global markets, because the Yanks have tried QE for a few years now. Obviously that's not materialized to any potential positive gain in terms of, given the fact that the unemployment rate is still quite high there, and all their economic data is pretty dismal. Okay, adding the fact that you've got the US debt ceiling concerns and the fiscal concerns, which is putting a drag on growth in America, that's not looking good at all. Adding the fact that the Japanese have obviously played the QE game, the UK has played the QE game. Now it's Europe's turn. Okay, so Europeans want to play the QE game, and it's a game of musical chairs really, and they'll keep playing it out until the music stops, and eventually all the economies will go into a spiraling downward move. Okay, given the obviously, especially given that Japan has been in deflation for years. Okay, so folks, so that's just some of your fundamentals. Let's just focus on technicals now. Okay, so technicals, obviously the weekly chart, a price action was already telling you, or forecasting, or telegraphing to you that we are coming into resistance. Okay, so given the downward sloping trend line that we have key resistance level. Okay, so obviously we hit that to the point, and you had upward sloping resistance channel, obviously which we didn't hit on the upside, although there was a lot of talk of the 1.4 level being hit. But given the fact that you had tapering probability opened again in December, and whispers of a rate cut in the background because of the economic data so dismal in the Eurozone, hence the reason why the Euro was hit. Okay, so this obviously slid on the way down, and which really coincides with the fact that the equities in global equities were in a bubble type environment, with the Nasdaq making a new high. Given that the FTSE itself has obviously been hammered, given that ExxonMobil, BP, Shell, all these energy companies are now reporting negative results, or not spectacular results, that again doesn't help commodities, which in turn obviously has caused oil to sell off quite drastically. Gold is under pressure, given the fact that you've got tapering, potential probability of tapering, and obviously deflation phase in Germany, which is a concern. Okay, so not looking good. Okay, adding the fact that the gold season, or the situation in India, isn't spectacular right now, given the economy is in a downturn. That again is hampering growth, and obviously if it hampers growth, the Indians don't consume more gold. Okay, so that's going to hurt demand for gold, and that's the reason why commodities overall are falling down, which I can explain. I can just give you a chart of the CRB index, and you clearly see the double top and then drop. Okay, so that's basically what CRB index is telling you. Let's go back to the EUR-USD chart again. Okay, so weekly chart, you can see clearly we're into resistance. We've had a bearish engulfing candle. That's going to stay. I find it very hard for the market now to go past 1.38. Certainly swing trades should, from my perspective, certainly be activated and looking for a move lower. Okay, so go to our daily chart now. Okay, so daily chart is quite interesting. Obviously, I can explain there was a resistance line there which we almost touched. We failed to penetrate. What the most important thing here right now is that we have a potential brewing H&S formation. So we have support here around the 1.3470 level, the 1.3470, 1.3480. Expect a little minor bounce here going into next week, given the fact that the Yanks will probably start talking about QE again. Idiots, okay, but that's their policymakers, absolute imbeciles and dimwits. Really, QE has failed, as Einstein always said. Keep doing the same thing over and over again, and if you expect a different result, you're an imbecile, you're a dimwit, and that's what these stupid policymakers in the US are. Okay, so they're just kicking the can down the road. They've kicked the can so much that they've probably got sore feet, sore toes, and they probably can't walk. Okay, so idiots from my perspective. But anyway, yeah, so right shoulder here, or keep an eye on that. Okay, right shoulder. Left shoulder was obviously around the 1.3630 level. Find it very hard for the markets to go there, given the fact that European equities are going to get some money flowing into it now, given the fact that the QE trade is active in Europe, and that's the place to be. Cheap money, market prices inflation, or asset price inflation, should I say, and everything gets inflated higher. So obviously repatriation of money flow into Eurozone, given the fact that the US debt ceiling and the US reserve status is under threat. Given there was some warning on Fitch on Friday evening as well regarding the US fiscal mess. So you are going to get money flowing into the euro, and that obviously will have some temporary support for the euro. So again, like I said, could create the right shoulder there. That's one of the reasons. Just generally speaking, we have had a substantial move of 400 pip move. Okay, so certainly some short covering is expected, and any short covering that does obviously ensue will not be anything spectacular. Okay, so keep an eye on that pattern there. The most important thing is that we have an unfilled gap around the 1.33 region. Okay, that gap I expect to be closed in the next week or 2 weeks, however long it takes for this pattern to play out. Okay, but that pattern should certainly be closed. We've got an upward sloping trend line here. Keep an eye on the neckline, which is around the 1.3470 level. Okay, so that projected target there is a 1.3050, given the fact that the head is 1.3830, the neckline is 1.34, around the 1.3440 level, 50 level, just call it 400 points lower. The main important thing from my perspective is that this gap around the 1.33 level should be closed. Okay, let's go to our 4-hour chart now. Sorry. Okay, so the 4-hour chart at H&S formation, obviously that played out quite well. Okay, and obviously we accelerated to the downside, given the fact that you had a double whammy. Tapering in December, opened again. Okay, which everybody didn't expect. It was caught off guard, hence the reason why the global equities have come off their highs. Okay, because it's all about the Kool-Aid. And obviously adding the fact that the ECB now talking about negative rates or potential rate cut, given the fact that there were deflation concerns and slow growth obviously throughout the Eurozone, and a lot of these countries are complaining, foreign ministers are complaining about high euro, okay, hurting their exports. So given the fact that we have quite a substantial move, we've got horizontal support around this region here, 1.3470 level, which again I've said on the daily chart is a neckline, and the weekly chart is an upward sloping channel support. Okay, so certainly expect a little short covering bounce here. Any little bounce will obviously, like I said, it will be very feeble, given the fact that you've got concerns of a rate cut. Okay, so bear that in mind. Anyway, either way, any sort of move higher will go into the 1.3550 level, 3560, 3536, even 1.36 as high as that. Create the left shoulder and obviously slam dunk down we go. Okay. 60-minute chart, obviously the market has sold off quite substantially. It's just, you can't really deduce anything from there other than the fact that you have lower lows, lower highs, and it's total carnage. Okay, better pattern recognition can be seen on the 10-minute chart. You have a downward sloping contracting wedge which is broken north. Again, that's a bullish sign. You have a downward sloping contracting wedge again looking to break north, probably hit the 200 MA, probably higher. Either way, this is showing that the shorts are looking to cover their position or cover their short position, and the market looks as if it wants to thrust higher. Okay, that's confirmed with the Aussie, which I'll probably do another video on the Aussie later on if I get some time and explain that. And that will, based on intermarket analysis, that will explain why the euro should bounce and have a short covering bounce. Any sort of bounce, like I said, will be feeble, given the fact that the negative rates or interest rate cuts on the horizon, and we have concerns about deflation. Okay, folks, so always remember, risk on, risk off. Take it easy. Goodbye now.